Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Dio, what's poppin'?
Hey, do you think you will ever get tired of being JC?
Yes, I'll get tired. I'm already tired of it. I'll be tired of it when we have T-Lop Live and people are like, do the thing, JC, do the thing. And that's when I know.
Look, we'll get you 2 Negronis and 3 Heinekens.
Right?
Yeah.
And I'll still be like, get away from me.
No way, John. You gotta be approachable.
No.
These people love you.
Oh, my God, no.
Yeah, they
no,
do
no.
love you.
Thank you. They love you, Dustin, and the multitude of knowledge you bequeath upon them every Tuesday and Friday morning.
It's so funny you used the word bequeath. I used it earlier today on
Did
a
you?
conference call. Yep, I was with our chief people officer. I think it's a fancy way of saying VP of
HR.
but I like it,
People officer.
I want to be chief of something.
I guess.
Yeah, but I'm the chief weed whacker of my house.
There you go.
Yeah, chief edger. But yes, I was on a call with her, a couple other people. Lots of big stuff going on. Lots of big stuff going on all over the industry, right?
You don't
Like,
say.
Crazy good, crazy bad, crazy like you can't control, crazy.
Okay.
But I was on the call and I used the word bequeath.
How
for
did
that.
you use it? I
What is
bequeath
it?
upon you? Because it's not like a word you can
Well-
like readily just.
Well, it's like, but normally you bequeath things like in death.
Right.
Like in death,
I bequeath. Yeah.
yeah,
right.
my baseball card collection goes to John Carmen.
Oh, Cole. Yeah. Let me know.
Yeah, there you go.
Do you have a baseball card
I
collection?
still do, yes.
Do you really? Does Jackson know? Do you have any like if you just
No.
went back and there's some like upper deck, just like heaters?
I mean, Ken Griffey Jr. rookie.
Do you really?
That's worth $17, I'm sure. Look, to a 12-year-old kid, $17 was a lot,
Right.
Especially back in 1991.
Hold on. So if you had it appraised in $17 back in
I
'91.
mean, from my Beckett, from
Yeah.
my
Yeah. Oh my God.
I have
remember.
probably 4 years worth of Beckett's.
Really?
The problem is it's been between my mom's attic, my bedroom.
They're not in the binder, in the spiral binder with the little.
I don't know. We'll see. We'll figure it out one day.
God, are baseball cards still a thing? They are making a comeback.
Are a
They're like
thing,
they're making
but
a comeback.
Still, they so mass produced the ones that I started collecting from 1987 all the way through like 1992.
Really? So it's.
That there's so many of those still in circulation. Nah.
I thought my Tony Gwynn.
That's like was it White Rain?
I don't know.
Yeah, White Rain hairspray.
White Rain.
Yeah, exactly.
What's that? Before my time.
You are a little bit young for that, but like imagine when you were like in
LA looks
in second and third grade, and you were
okay.
like you were so crushing on those middle school girls, and they had that real high bangs.
Oh, that's what they
yeah,
used to
they're
keep it up
spraying
there.
on the
Oh,
White
okay.
Rain. Yeah,
that's what it was. Yeah.
Yeah, it's a Jason Aldean song that talks about spraying
Right.
on the White Rain.
Okay.
Yeah, I know you listen to country music all the
I
time.
mean,
Bro country, nonetheless.
Whatever you have playing, I'll listen to.
Bro country.
I appreciate country every once in a while on the 45-minute drive I have home.
Okay. Do you go to like a Pandora station?
No,
or?
I just go whatever's on the radio and I'll listen to something. Like I respect, you know what I'm saying? It's nice to change of pace. I don't listen to that mumble rap shit that they got going on now.
Mumble rap is terrible.
You know,
It is terrible.
It'll phase itself out.
I hope so.
You know what won't phase itself out?
Hopefully this year will.
Right.
No, hopefully this year
Good, I
will
was
phase
right.
itself
Good,
out. Yeah,
good,
so
good.
no, that's what we're gonna just get into it.
Okay.
And this happened from mortgage school yesterday, right? So I teach mortgage school on Wednesdays, and I was doing a mortgage school a couple days ago, and I came in fired up.
And literally walked in the door. No one asked him a question. He's like, I know no one asked me this, but I'll just go ahead and tell you. And then 15 minutes later, he's like, all right, sorry, guys. Any questions? So it was great. No, it was great. It was so good that it became the topic for today's episode.
It did become the topic of today's episode, and I don't know, because of how fired up I was, that's like something I could do at a T-Lop Live. I don't know if I could do it and have you post it on tloponline.com,
Okay. Right.
where we have a lot of great sales tools and
Shit ton of
videos and
content,
training
yeah.
and tons of content
Hundreds of videos.
on the website, theloanofficerpodcast.com. Just like, the content's obviously hosted.
Somewhere.
Well, this right here is on YouTube,
Mm-hmm.
or this right here is on Spotify, or it's on
Apple,
et
Podcast,
cetera,
Stitcher,
et cetera, right?
et cetera.
And we're on all of our little social handles and stuff,
Yeah.
so we're there. But we really love and we're digging what we're doing on T-Lop Online. And what happened the other day when I was teaching mortgage school, sometimes you take clips.
Yeah.
I saw you posted a clip from mortgage school
Yeah.
on Instagram yesterday. That was pretty cool.
Yeah, it's great.
What's crazy is I don't even remember
I
saying
know
that.
you literally when you get up there you do black out. What I say, I'm like, bro, it was like 25 weeks ago.
Yeah.
By the way, it's a year ago anniversary. By the way,
What is?
a mortgage school? You started
Mortgage school. I
school
started mortgage school a year ago.
A year ago.
Wow. Well, what's really cool is we actually had a local, soon-to-be mortgage professional who's studying for her license actually came because she's local.
Okay.
And she came to mortgage school.
No way.
How cool was that?
That's
Yeah,
awesome,
shout
man.
out to Rachel.
Shout out Rachel.
Shout out Rachel for swinging by. It was a pleasure having her in the office. And she had to sit through mortgage school. She actually sat with one of our loan officers that she had recently met and
Travus.
put 2 and 2 together.
Yep.
Yeah, so she had to shadow him for 2 or 3 hours. Like, what a great way to figure out, is this really what I want to do? She went and shadowed somebody.
Yeah.
Yeah, it's pretty cool.
Yeah.
So you're right. I walked into mortgage school, and here's the deal. The year's 2022. This particular mortgage market, it's schizophrenic. It ain't fun. It's our crazy ass friend who has emotional issues, but we still love to party with.
Love to hang out with you, man.
Yeah. Sometimes in small clips.
Yes.
Intermittently.
Intermittently, yes.
Intermittently, let's hang out. Like for 2 hours.
Yeah, 20 minutes. While I'm sitting in the car and you're in your car.
Not
I'm just
necessarily.
talking to him.
Yeah. It's more like, hey, I'll meet you for drinks, but maybe not drinks and dinner. Hey, I'll meet you for dinner, but maybe we're not going to go out afterwards.
Right.
Or, hey, let's just not go out and just come over to the house.
Yeah.
And I'll cook some steak on the grill and we'll just chill.
Low key.
Yeah. But like that's going to be 2022. This mortgage market that we have entered. Whew, I mean, you're talking about interest rates have just shot up from 3.25% to 5.25%.
Skip forward.
You're talking about there are 30 pre-approved borrowers or potential home buyers, but only 8 homes for them. You're talking about the mortgage industry increased their body count by 30%. Like, so you go back to 2019 and you look at how many mortgage professionals there were, there's 30% more today, which I think is amazing because we need younger, fresher, hungry, aggressive, maybe not rich yet, but they want to be mortgage professionals.
Yeah, you do.
And you also need them because there's a lot of old-ass mortgage professionals who are going to be retiring, or they should have been retired, or some of them, unfortunately, are coming to the end of their lives, and they're being forced out that way.
Yeah.
So it's great that we're having new, younger people coming in. We want that.
Yeah.
But anytime that your head count increases by 30%, you have to feed that amount of people. If you went from 400,000 to now you're at 520,000, that's 120,000 people who are expecting to be fed.
Yeah.
Or if you went from what was probably 1 million to 1.3 million, that's 300,000 people who need to be fed, who need to earn a living, who are trying to get a paycheck.
Yeah.
Well, at the time, we were doing trillion dollars in mortgages in 2020 and in 2021. We get to 2022. Let's look at 2.4 trillion. That's about a 40% decrease. 40%, like gone.
But you still got all those people working.
Still got all those mouths to feed.
Yep. So what happens?
You tell me. Right? Here's the unfortunate thing. Certain people are going to be given the opportunity to seek employment elsewhere. That is the pink slip.
Well said.
That's like, hey, look, we don't need you. Now, some companies, it's last in, first out. Like, hey, that's just, look, you're the last one that we hired, you're the first one out.
Right.
Many companies, though, they use this as a time to strengthen their team. Right? We're looking for elite players.
Trim the fat.
Yeah, if that's what you want to call it, yeah. I call them looking for elite. So if my body count had surged because out of necessity, but now the necessity is not there because the market itself, the amount of pie that's available to eat has shrunk, then I need to go out. Well, I need to decrease the number of mouths I need to feed off of that. Right. And I'm going to look at it and see who are my strongest players, right? Who brings the most value? Who has the highest trajectory? Who has the highest ceiling? Who do I think I can actually get 20% more productivity to? Because this is a year, mortgage professionals, I'm not going to shy away from this, and I'm going to celebrate it because I want you to celebrate it. The mortgage market is down 40%. You're going to win if you're only down 20%, but you'll be down. Okay, we are coming off of 2 of the best years ever. It doesn't matter what this year is going to be like. It was going to be worse than last year. You can't just consecutively do what we did in 2020 and 2021. Like, it's just not realistic. So whatever it was going to be worse. So if the market's down 40, your goal is to be down 20. There's going to be some that are down 80, and those are the ones that are going to find themselves seeking employment elsewhere, and elsewhere may be different industries. Now, for the elite who are competitors, you may grovel in that. You may appreciate that. Like, hey, look, I need to get rid of some of these pretenders. Some of these people who are only producing 1 and 2 loans here and there. Now, if you're producing 1 and 2 loans because you're a rookie, nah, man, this is the best year for you to get started.
Really?
This is the best year.
Why do you
I
say-
wouldn't pick any other year.
No way.
Yes.
Why is that? Because usually you would think I want to come in and refire you, easy
Hell
money.
No. No. Well, one, there's never a right or wrong. It just is. There's never a bad place to start a new career. Start somewhere. Even if it's your worst employer, you now have a base.
Yeah, somewhere to start, yeah.
Yeah, you have somewhere to start.
Yeah.
You're going to gain experience. You just might stay there. You might not stay there for more than 6 months.
Yeah.
So there's never a bad place to get started. But I would tell someone, look, you get started in a year like 2018, a year like 2022, because 2018 was the last time we saw something like 2022. Which, by the way, me, my friends, my colleagues, my associates, we all made really good income in 2018. We worked 20% harder, and we made 20% less than we did in 2017 and 2016. But nonetheless, we made good income. We provided for our family. We saved for retirement. We saved for college education. We went on vacation. Now, my vacation may have been to the Florida Keys because I live in Orlando and I can drive down there.
Word.
Versus Hawaii, which is $1,000 airline flight.
Yeah.
Right, but I still went on vacation. So like don't get me wrong, 2018 was still a decent year. 2011, 2012, 2010, those weren't great years. They were great years for me and my 2 business partners because we grew our practice, our firm, by over 300% over those 3 years. This year is going to offer those same types of growth opportunities to the elite. They're also going to offer some false narratives to people who are easily susceptible to being convinced that the grass is greener. So, right, this is where it's like that schizophrenia that I was talking about. Like, it's going to be a schizophrenic year. Like, look, $2.4 trillion in mortgage volume is still a good amount. It's still enough to make a really good living off of. It's just not $4 trillion. And yes, the added headcount is going to create some competitive pressures because now everyone's going after 2.4 trillion versus everyone going after 4 trillion. So people are going to fight. People are going to get bruised and scratched, and there's going to be losses and knockouts and chokeouts, right? Which means you're not going to win every battle. You're going to have competitors doing some crazy
Shiesty
stuff. Not even shiesty. Just like you look at your rate sheet, you know what it takes to pay for processors and underwriters. You know what it takes to pay for your credit report, your copiers, your laptops, your monthly fee to your CRM, your monthly fee to your LOS like Encompass. Like, you know what it takes to keep a good loan officer employed and paid. You know what your health benefits cost and your 401k is. Like, look, at the end of the day, we're kind of running the same business model. Ford makes cars very similar to Toyota, who makes cars very similar to Nissan, who makes cars very similar to GMC. I mean, yes, there's some nuances, but for the most part, it's the same assembly line process. Same thing goes in the mortgage industry. So you know the cost it takes to create. There's, by the way, companies like Stratmore who do research, and then they publish that research, who basically tell us in the industry that, yes, what you're doing is on par with your peers. So then when you see your peers offering an interest rate that when you run the math, because by the way, we all borrow money off of lines of credit, and the interest rates on those are pretty much close to the same. They're not variable enough that one would be given a competitive advantage because their warehouse line of credit was so much cheaper than someone else's. And we all sell our loans into the same exact secondary market, at which point I can go online and see what things are trading for, and I can get a bid tape to have loans, to get bids on my loans. So we had the same buyer, we had the same process, which means we had the same business model.
Yeah.
So when I start seeing that so-and-so has X rates, and those rates are lower than me and my 5 friends who work at competitors, my mom and dad taught me, if it looks good, too good to be true, it may be. So what you end up getting is there are some people out there who, look, they don't maybe necessarily have the best programs and products. They don't have the best leadership. They don't have the best systems. They don't have the best marketing and the best sales support. They're not coaching. So their only way to either maintain what they have or attempt to grow is to do so by buying the market. Okay, tech companies do this. Amazon did this and it worked out. Better.com's trying to do it, and right now it's not working out. Zillow tried to do this with Zillow home offers. They're done doing it. Open Doors trying to do it, and they're losing their rear end, right? So yes, Amazon did it and it worked. Facebook did it and it worked, but there's so many others that we've never heard of, and there's a reason we haven't heard of them, because it didn't work. But you get these companies who their only answer is we have to buy the market, which means we're willing to do loans and lose money. Maybe they have a fat savings account, but at some point, think of your personal life. If you lose money every month and every quarter, at some point you run out of money. At some point, that savings account runs dry. There's other companies that'll come in because they're trying to grow. Their only thing is grow. Because here's what they want to do. They want to get LO headcount, meaning they want to add salespeople. Yeah. They're going to convince the salespeople to come work for them because their rates are the cheapest.
Look at how low our rates are. You can't get these rates anywhere else.
Yep. And then once they get them in the door.
Oh,
wait a minute.
Hey, chill.
Hey, I got John. He's that cool frog that I just tossed in this big old nice cold pot of water.
Yeah.
Let me put the heat on number 2, John.
I like this water. It's tasty.
Yeah,
it's
number 4.
Well, it's still fine. I can't tell the
hey,
difference.
John, we're tired of losing money. I got to go to level 7.
Okay, what? Wait a minute.
What you're cooking.
Okay.
Oh, you're hot. Oh, you may be dying. That's what's going to happen. And look, people do it. Some people do it strategically, and it works. I want to open a branch in Raleigh, North Carolina.
Okay.
So for 6 months, I'm going to go into that market, and I'm going to show those loan officers a super cheap rate sheet and really good rates, because I want to buy the market. I want realtors and borrowers and buyers and loan officers to all want to work for me. Hopefully, I'm also have really good leadership. I have a really good, smooth process for getting loans closed on time, and I have great sales support and coaching and mentorship. But I do that, but then I know it's temporary. Like eventually,
I'll have to start jacking the rates.
I'm going to have to start increasing those rates, because eventually I have to make money. Eventually, I have to have another product. And mortgage companies don't have other products.
Widgets.
Like if I was a car company, if I was Honda loses money on the Honda Civic. Did you know that?
Yes, actually I did.
Yeah, they lose money because they don't want to make money on the Civic. The Civic is what they get you in so you fall in love with the brand.
Right.
Now they're going to make money on the Odyssey.
Yep.
And then when your kids get older, on the Pilot.
Yeah.
That's where they make their money. They don't make it. So you can, for a quarter or two, say, hey, look, my Raleigh branch is going to be a loss leader. But I'm going to get these people in. I'm going to get them comfortable. I'm going to get them acclimated. And then each quarter, each month, each week, I'm going to ratchet up my rate sheet. 5 bips here, 10 bips there, 25 bips there, until I'm back to a business model that, by the way, all my peers follow, because we all make the same widgets following the same business model within probably 3 to 7% variance. So what this market is doing, because we've seen rates go from 3.25 to 5.25, refinances went away. We saw $4 trillion in volume go down to $2.4 trillion in volume. We saw a 30% increase in headcount. Dude, it's a scramble for the little bit of business that's out there. And some people are dropping their pants to get it, whether it's the originator, whether it's the mortgage companies. But at some point, you can only do that for so long until you go bankrupt. And then if you're that loan originator who's working for the company that is losing money because they're offering you an interest rate that is
not sustainable,
a quarter percent better than what the market's offering, let me ask you to ask yourself this. Do you want to work for a company who's on the verge of bankruptcy? Or do you want to be your employer's pawn? Maybe your employer has the end goal of selling their mortgage company, but they can't sell the mortgage company until they get to X headcount, until they get to X volume. And then once they get to X headcount, X volume, they became effective. My buddy Brooke taught me this. You first become effective, you second become efficient. So they become effective with headcount and volume. Now that it become efficient, more or profitable, then they do the whole bait and switch. I got you in. I got you over. I made you believe this was going to be your rate sheet. Now I'm going to ratchet it up.
You got catfished.
Now I'm going to sell the company. Whoa. Unless you were coming in. Hey, look, if you negotiated that you had equity in said company.
Oh, okay.
Hey, sign me up.
Yeah.
You want to give me equity in a company that we're going to grow and sell, and I can get this big $1 million payout?
Something that doesn't happen too often, does it?
No.
Right.
No. Yeah, one person gets paid.
Yeah.
Maybe 4 or 5 people get paid, but no, not the lowly loan officers and loan partners that got duped to come work for them. So now all of a sudden you went over, you busted your butt. By the way, anytime you move, it's disruptive. So you moved companies, You ingrained in the culture. You fell for their super cheap rates. Now, I'm not saying, by the way, this happens all the time, but I'm saying this does happen. I'm saying you got to be on the lookout for it. Like, these are things that are going on. This is kind of what I was talking about in mortgage school. Mm-hmm. And I am all over the place, people. Like, I am. Deal with it. I hope you like this episode. Because there's a lot that I can say, and there's a lot I'm trying to pack into whatever it's going to be, 25, 35 minutes. And understanding that in a market like this, it gets super competitive, and people start cannibalizing each other, and recruiters take advantage of that. And they know that you're feeling pricing pressures because guess what?
Everyone else is too.
Everyone else is too. They know this. Recruiters, that's their job. Their job is to reach out to you and recruit you. And what they're going to use is your one Achilles heel. Like, what's the one thing? Oh my God, my rates. It's everyone's rates. The whole entire market went from 3.5 to 4 to 5. I'm sorry, from 3.5 to 5.5. Yeah. Like, so if someone's showing you 5, please know that that's probably, I'm going to give myself an out here. That's probably false. That's probably temporary. You're probably somebody's pawn because maybe they're trying to build a company to sell. You're somebody's pawn because they're trying to open up in a new market, or they're trying to just keep their nose above water, and they're doing anything in their power to do so. And maybe their only way is to lead with price, to gain headcount, gain volume, and hope, which is not a good way to run a business, is hope. To hope that they become profitable.
Right.
Versus looking at, how am I delivering these loans? What is my average unit per FTE? What's my average closing per loan officer? What's my product mix? Like, there are ways in a market like this that you can cut costs, where you can increase productivity, right? There are ways that you can adapt to what is transpiring without having to throw Hail Marys, unless you're not good. So, like, this is when I said, so again, schizophrenia, bipolarness.
It's okay.
Like, and we're not the only good company. So companies like the one that I have an opportunity to work for, and I have been for the past 14 years. This market, the best growth opportunities we have ever seen.
What? That don't make
seen.
What? But
ever seen.
But there's less. What do you mean?
Ever seen.
How? How is that? Please do explain.
When you're elite, you're elite, you're elite. And we are not the only elite mortgage company out there. We're not. There are dozens of other really good mortgage companies who do it well. But when you're elite, and when the shit hits the fan and the going gets tough, there's a flight to safety. In years like 2020 and 2021, I never answered your question like why I would want a newbie or a rookie to get started in a year like this. A year like this forces you to get good. It forces you to learn the business the right way. I dotted, T crossed, top button buttoned, cuff links on. Like, you're going to go to war, and you have to be great. You have to be a warrior. 2020, 2021, you could walk out of your house and get hit by an Amazon truck and have 3 refinances fall in your lap.
Yeah.
That's not the mortgage industry. That's not being an advisor. That's not being a local community expert. That's not. Yeah, that's
those kids on TikTok being like, I'm an LO, I closed, look what I did. Here are 3 of these steps, and they start pointing to the air. My favorite.
Yeah. No, that's not this industry. Now, should you be on social media? Should you be creating videos? Of course.
Yeah.
But no, it's not that, oh my gosh, I got my license and I made $30,000 last month. That's not what it is. So people that found success in 2020, 2021, many of them, it wasn't because they were good. It's because the market was phenomenal. So if you're learning this business in 2022, it's going to force you to become great. We've done some really kick-ass episodes the previous 2 or 3. Like, those episodes are the ones that people who want to be great should be tuned into. And we've done some pretty decent episodes, quite honestly, John, for the past 2 years now. We have 200 plus episodes, and we have TLOP online that people should be checking out. So I was talking, again, I'm kind of bouncing back and forth, but I wanted to answer that is why I think this year is going to be what it is. Like why it's the best year, because you want to learn, you want to get good when it's hard. That way, when it becomes normal again.
I'm like, oh, this is not easy, not a cakewalk. It's like, oh, I got this.
Yeah, you have every system, every process in place. You are forced to become great early. And then you prepare yourself. You prepare yourself for the next 2020 or 2021. You prepare yourself for the next 2014, 2015, 2016. Those were 3 great years, by the way. You prepare yourself for the next 2003, 2004, 2005. Those were 3 great years, by the way. My wife said to me the other day, she's like, you didn't really earn that money you made in 2020 and 2021. Like, don't kid yourself. She was calling me out. She was maybe right. Like, my efforts, my hours worked when divided into my W-2. No, I don't know if anyone ever earns, that type of money that puts you in the 1%. But I did get a little defensive and remind her. I said, but honey, I earned that money by grinding through 2018, which, by the way, it wasn't fun. It was a lot like 2022, and it made me 2 times the better mortgage professional because of it. I was 2 times better January 2019 than I was January of 2018. I said I earned it in 2012 and 2013, or I earned it in 2009, 2010. It was what I built along with 2 partners for a decade plus that put us in a position to capitalize. So what people are going to do in 2022 is you're putting yourself in a position to capitalize for October of 2023 or January of 2024. Like, that's what you're preparing for. And this year is going to force you to become great, because if you're not great, you won't survive. Right? If you don't take yourself serious, if you don't act like a professional, if you don't act more Wall Street than Bourbon Street, if you're not getting up every day and putting on your uniform and going to work with the idea that your number 1, number 2, and number 3 goal and responsibility is to create a lead, talk to a person about a home loan and help them add value to their lives, help your referral partners add value to their business, you'll find yourself out of this industry. So our opportunities here at Waterstone, look, we are elite. I'll throw it out there. I will throw it out there. We're elite. We have fantastic leadership. We have fantastic sales support, systems, processes, underwriting, products, all of that. Interest rates, they're competitive. They're not the industry leader. We're not going to wow anybody by showing you the rate sheet, but our rate sheet's going to be true. It's going to be honest. It's going to be real. And when you compare us to what is going on amongst the bulk of the competition, we're going to be in the same exact ballpark. Maybe some days we're 40 bips better. Maybe some days we're 40 bips worse. What I tell anyone to do, and by the way, write this down, sales professionals. Go to your friend Google. Google, what are interest rates in, and then insert your state. What are interest rates in Florida? What are interest rates in Maryland? What are interest rates in Massachusetts, California, Texas, etc.? Look at that. Show that to your clients. Show that to your realtors. Compare that to your rate sheet. When I do that,
not that far off.
I'm better most times.
Right.
Or I'm exactly the same. That tells me that I'm working for a company who's running a sustainable business that'll make sure it's not just here for me today or here for me tomorrow, but it's here for me in 2030, in 2035. Because we're not going to do anything stupid. We're not going to do some kind of a crazy freak out that causes us to originate a bunch of loans that don't bring profit to the company. Because if a company's not profitable, eventually you end up bankrupt.
Right. In this market, how long would you say until the dust settles, i.e. cream has risen to the top, we've kind of trimmed all the fat? Would you give it like this
18 months.
18 months?
18 months. The good news is you're 4 months in. You're 4 months in, right? So you have another 12 to 14. Let's get through first quarter of 2023, because usually first quarter is super competitive anyhow.
Right.
Just because it's the slow season and you still have a lot of mouths to feed and still a very, very little volume.
Right.
Once we can get into like April, so 12 months from now of next year, things should subside.
Okay.
Because you're going to get some pretenders out.
Right.
Hey, it just happens. We need it. You're going to get some people retire. Luckily, some of our listeners are going to backfill.
Right. Yeah.
Right? They're going to become great in a market like this.
Right. And
they're going to backfill those that are retiring. The madness of what's going on with the crazy volatile interest rates and what's going on with home prices, et cetera, like that'll start to subside. We'll have an idea of recession, hopefully, of inflation. Hopefully that'll be going down. We'll probably be slowing our economy down. We'll probably be heading towards a recession. Recession is going to bring a drop in interest rates. Yeah, but I think typically it's about 18 months and you're about 4 months into it, but celebrate it because 2.4 trillion is still a lot. Look at it historically. Look at how many What was the volume in 2012, 13, 14, 15? I do not believe it was 2.4 trillion.
Mm-hmm.
I do not.
Are there a lot of ebbs and flows in this industry, given like, all right, expansion, contraction? I'll give you an example. Back at EA, when we ramped up for the launch of a video game, we needed more staff. You need to test the game. It's about to launch. So then we'd increase our temporary staff for bug testing, let's say. But when the game came out, kind of cut off. So every year you could kind of predict like June, it'd get really busy and then it would contract again. For the mortgage industry, are there any kind of predictable analytics you can use for that? Or is it usually when there's a crisis like a war or housing or recession? Does that make sense?
Well, there's the general cycle of January, February are your two worst months. Things pick up in March. They peak in August, and then they slide back down and get a lot worse in October, November. You have a good spike in December. Like we have that cycle.
Right.
But then you also have the interest rate cycle. Like, yes, every 5 to 10 years, there's some kind of a refi boom that tends to happen.
Okay.
And that refi boom, you'll see ebbs and flows, especially the companies that are like 95 or 99% refi.
Mm-hmm.
Like, why is Better.com losing $50 million a month? And why is, well, that's because they run an unsustainable business model and their interest rates are too cheap. Period. End of story. Their interest rates are too cheap. Therefore, they lose $50 million a year, a month or a quarter, whatever it is. It's a lot. They're also laying off 900 people here and 900 people there. And then they're asking people, this is all in the news, hey, John, I'm not going to lay you off, but I really would like you to volunteer to quit.
Yo, what?
Well, look, 99% of your business last year was refi and refis are down 60%. Like, yeah, there's going to be a lot of hiring and a lot of termination. So those companies that when the rates are low, they do a lot of refis.
Oh, okay.
Then you have bigger ebbs and flows. Like what we teach and coach here on TLOP, refis are awesome. We do them. That's why we have a past client database. That's why we market to our circle of influence. But even a year like 2020 and 2021, it shouldn't have been more than 50% of your business. And for many of us, it was like 35% of our business. Because in a year like this, it's going to be 5% of my business. And that's fine because I'll still be able to close at a very high level as compared to my peers because I focused on sustainable by referral only business. Sustainable is purchased, by referral only is I market to my friends, my family, realtors, even more realtors, builders, maybe a couple divorce attorneys, maybe a couple CPAs, and I work my database like crazy.
Right.
Like that's what we do. But that's what's going on. And people should, in one essence, freak out. In one essence, get excited. In one essence, don't get duped. Don't make a long-term decision based on a temporary problem. Ooh, think about that. A long-term decision. Uprooting yourself and leaving a great company because someone is dangling a flashy rate sheet. Or someone's dangling a fancy sign-on bonus. Or a guaranteed commission for 3 or 6 months.
Come on over.
What happens in 6 months when that guaranteed commission or sign-on bonus evaporates? What happens when that too good to be true rate sheet starts getting tweaked and adjusted? Well, is this really your forever company? Now, if it is, it is. If you're currently at a company that you're like, there's no long-term solution here. I talked about the explosive growth that we're going to experience. Yes, we're going to experience it because there are companies out there that can't get loans closed smoothly, predictable. There's companies out there that don't have a product selection that's needed and required. There's companies out there that have no leadership or terrible leadership, or they don't have sales support. They're not coaching their loan officers. They don't have a CRM or prospect drip campaigns and all the things, all the bells and whistles. They don't have the technology and they're not investing in the technology. By the way, think about that. If you go and work for a company that is losing money, you know what they're not doing?
Reinvesting it back into the company?
Yes, they're not reinvesting it back. And if you're not a mortgage professional that embraces technology to do your job and give yourself a competitive advantage and your company doesn't do it, dude, what longevity do you have? We're already trying to outrun the robots and the artificial intelligence.
Right.
That is something we have to do. We have to embrace technology. But if your company's not making money, they can't afford to invest in it. So think about that when you're chasing sign-on bonuses. Now, again, when you're making a decision, why should you leave your company? It should never be about a sign-on bonus. It should never be about what the guarantee is going to be. It should never be, that rate sheet, because those are all temporary. It should be about the leadership. It should be about the sales culture. It should be about is this the place that I can actually grow my business? Is this a place that actually there's trajectory? Are these the types of people I want to synergize with? Like if the answer is yes, then you make sure that their rates are no worse than the rates that you're already used to selling. Like there is a certain like sniff test.
Yeah, right.
Like, hey man, let me, you still do your due diligence.
Right.
Don't get me wrong. And look, you still ask for some kind of a sign-on bonus if you've earned it. You still ask for some kind of a guaranteed commission if you've earned it. Right? I'm not saying you don't. I'm just saying you don't make your decisions based on that because those are temporary solutions that to a long-term problem.
Let's say I'm a loan officer and I have a recruiter hitting me up. Is there any like a rate that they're quoting me that I should be like, like, hey, that's too.
It doesn't matter.
Doesn't matter.
I mean, no, it at all. It should never be about rate.
Right.
It should never be about a certain program. Oh, they have this really good renovation loan. Dude, that thing can be stripped from you and them in 3 months. Oh, but they do this product and program really good until they don't. Like it always baffled me. Like, granted, I love talking about the fancy products we have here at Waterstone because it is cool.
Right.
We had this amazing loan product called Select Smart Plus. It was 97% financing. It came with a 4% second mortgage. That means it's 101% financing. 30-year fixed, no monthly mortgage insurance. It was amazing. And then COVID hit and the whole entire product went away. Went away. Like, if someone came and worked for me for only that reason just left. That's not the right reason. If I went and worked for this bank because they have a really good doctor loan, until what? Until all the competition gets the same exact doctor loan. At which point, where's my competitive advantage? Right. So those are also things. And all of this rears its ugly head in a year like 2022, in a year like 2018.
Right. We were talking about this a couple years ago.
In years like 2011, 12, and 13.
Right.
Yeah. I did my best growing in 2010, 11, and 12 as a branch operator, regional manager, VP, whatever you want to call me. Those were awesome years, right? 2018 gave us some good years. Around 2000, that was TRID was 2010. And then this year, because we're purchase focused, we're sustainable, we support like all those intangibles. It didn't matter in 2020, 2021. Again, you could walk out of your house, right, and trip over a $10,000 commission check,
right,
because someone was just begging you to help them save $400 a month on their mortgage.
Right.
Yeah, it's not the case anymore.
Wow.
Yeah, so people just have to be cognizant of what's going on and like try to think rationally. Like try to like put on your like bullshit meter. Yeah. Like, is that bullshit? Does that sound too good to be true?
Probably is.
Or like, hey, cool, I love your rate sheet, but what else do you have? Because I don't trust that those are the rates that you're going to be delivering in 6 months from now.
Whoa, I don't like the kind of questions you're asking, kid. Maybe you're not a good fit for this company.
Yeah. How long have you been around? How long has your branch been in operation?
Sounds like you got to interview your employer before you go over there.
Yeah. Hey, which of your producers, both here and outside of here, can I talk to? Right? Ooh, I'd love to price a loan with one of your loan officers in a different market.
Whoa.
Yeah.
Why? Right.
Like those are just some of the things. And just keep in mind that, you should make a move if that move is for all the right reasons. And that's what's going to benefit you long term. Look, just because shit got tough and you got to work harder.
No, I want to make
you got to prospect more.
Right.
Right. No, what that is, that's weak. That's running away from the man or woman in the mirror.
Don't wish it were easy or wish you were better.
Yes. Don't wish it were easy or wish you were better. Do you know who said that?
Jim Rohn or something.
Jim Rohn. Jim Rohn. Yes. Like that is it. But look, it's kind of like when I remember back in my college days, right? And like my buddy and his girl got in a big fight and they broke up. And then I ran into her like the next weekend.
Oh, we're back together.
And she chopped her hair off and she dyed it.
Yeah.
I'm like, what are you doing? I needed a change.
Yeah.
I'm like, man, how about just quit being psycho and sit down and apologize and y'all get back together and my buddy will stop, being curled up in a fetal position crying on my love seat in my dorm. Right. I mean, people do that. That's just whether they're 21, they're 14, or they're 44. It's way easier to make a crazy change like cutting my hair or shaving my beard, or I'm just going to go work for the competitor down the road, because at the end of the day, they're looking for an easy way out. Like, oh, where's that pill that I can take that'll make me not fat anymore?
The easy pill. I don't want to go to the gym. Just make me look gorgeous now, damn it.
Yeah, no, that's not this market. Embrace it. Embrace the suck. Understand that you're going to have to work 20% harder to make 20% less, but you're going to be a better professional because of it. That's what I want people to know from this episode. And it's okay. It is okay. You'll be grateful that you did it. And if you need a shoulder to cry on, find one. Learn to express yourself. Find a buddy. But make sure your buddy doesn't enable your negative thoughts, but picks you up, right? Make sure they're a better or an equal rational thinker as you, because this is not a time where you want to be negative, because negativity breeds more negativity. Mm-hmm. Understand what's going on, be okay with it, recognize what you need to do, and then control it, and then get after it and get you some. Because the work you put in today is all that money you're going to be able to make next year, the year after, the year after. He's John Coleman. I'm Dustin Owen. You've tuned into the Loan Officer Podcast. If you ever want to connect, find me on LinkedIn. My first name is Dustin. My last name is Owen. His name is John Coleman. I will not give you his contact information, but I will encourage you to go to Google. In the meantime, check us out, tloponline.com, theloanofficerpodcast.com. Peace.